Okay, good morning, everybody. Thank you for joining us. This is our first in a series of webinars covering the business lifecycle. And today, as it says on the screen there, we're going to be covering the growth phase of the business lifecycle. So this will take probably just under half an hour to run through. It will be recorded, so it'll be available to watch back on the Menzies YouTube channel. And for those who have attended, you'll also receive a follow-up email with a link to this as well. Just by way of a quick introduction, my name is Rob Cooper. I'm a director in the Solent office of Menzies, primarily undertaking business advisory, R&D tax relief, statutory compliance, and I specialise in technology businesses. We're not planning on doing a Q&A today on this, so if you've got any questions you want to ask, feel free to email myself directly, or if you've got contact at Menzies already, then feel free to speak to them, and they'd be more than happy to speak to you. So just by way of an introduction to the series, I'll just briefly explain the business lifecycle for those that might not be familiar with it. Typically, a business lifecycle is broken down into 4 key phases. So these phases are the startup phase, the growth phase, the maturity phase, and the decline phase. So just because this curve is built in this way doesn't mean that every business follows this curve. So they don't all go through growth, maturity, and then decline. It may be that a business goes through growth and then maturity for a while, and then they go through a further stage of growth. It might be that they've actually gone into decline, and then they go into a phase of growth to reignite the business. So today we're focusing on the growth phase, as it says here, but in the series we also have 2 further webinars, one on the maturity phase, which is scheduled for the 24th of February, which is going to cover how to plan and prioritise for the medium and long term. And then the second one, the third one, we're actually going to cover the decline phase, because typically what we see is rather than our businesses going into decline, our clients actually go through a series of succession or exit planning. So currently we've scheduled that for the 24th of March, with times to be confirmed on that one. This will be covering those topics. We weren't specifically looking to cover the startup phase, as many of our clients and many of you on here will probably already gone through that element. But if you've got any questions on that, if you've got anything you want to discuss, any questions you wish to ask, again, feel free to contact myself or one of your contacts at Menzies. And you'll also see on the page here, I've got a web link to our Menzies Insight section of our website. This is a section of our website which covers all sorts of areas. We've got pre-recorded webinars, we've got lots of articles on there covering all sorts of advice and elements of business, which will fit in either somewhere on this business life cycle or just generally wherever you are at the moment. There's a QR code there, which I'll leave on just for a moment, so you can click on that to take you directly to the page. So again, we're looking at the growth phase today. And who is this relevant to? Well, it's relevant to any business that is in the growth phase currently or is planning to go into the growth phase. So again, just going back to the curve, this shows growth straight after the startup element. But actually, you could be anywhere. You could be a well-established business and you're going into a new phase of growth. COVID has changed the landscape quite a lot in the last couple of years. So it could be that where businesses have struggled, others have gone into new phases of growth they weren't expecting as a result of this. So just to go on what we're going to cover today, it's quite a large topic, so we're not going to go into anything in loads of detail, but we're just going to cover these 5 areas here. So planning growth, barriers to growth, and sort of understanding those. The practical considerations to think about when going through growth or planning for growth. And then we'll talk a bit about risk management and cash flow, which are 2 key bits that run through most of the growth phase. So we'll start on planning for growth here. Personally, I can't express how important this is. We've got 3 key points that I just want to make on this one. So the first one is plan your path. Not just the end goal, not just where you want to end up, but how you're going to get there. What are your interim targets? So along that path, what are your measures that you're going to get yourself or set yourself against? So is that measurement going to be sales revenue? Is it going to be the number of customers you have, the number of transactions you undertake? Or it might be ultimately you're looking at that profit margin. What you've got to pick here is a measure that's appropriate for the business and accurately sort of identifies how the business has grown. Not one measure is right for every business. And just looking at sales turnover, that indicates that you're maybe making more sales, but it doesn't necessarily indicate overall growth in the business. The second point here, to not just wait for it to happen. And if you just sit back and wait for growth to happen, there's a good chance it might not. If you enter unexpected growth, you might lose the ability to take advantage of it. You might be so far into that growth phase before you actually recognize it, and therefore you can't react quick enough to take full advantage. Anything you do at that point might be a little bit too late. And if you've entered planned growth, you'll actually have an idea of what's coming next, what you want to do next, and how you're going to react to that. So it's very important to then plan that path as we run back to our first point. The best performing businesses that we see are those with proactive, forward-thinking people behind them, and not those reactive people that are just waiting for something to happen. That said, you could enter unplanned or unexpected growth, as I've mentioned already about because of COVID or some other reason. At that point, it's not too late to plan your way through the rest of the path. Okay, it's never too late to try and think about, right, what comes next. It's certainly better to try and do that rather than drift along and just see where you end up. And the final point on here, I've got to get a good advisor. Now, obviously, it's easy for me to say that being an advisor, but it is true. You're running a growing business, or you're involved in a growing business because you're good at what you do. You couldn't possibly know the answers to everything, and nor should you. You've got experts around you that can help you with those things. So select a good advisor, have open and honest discussions with them about your growth plans, and that will make sure that you're informed about every decision that you make, and that you're going to be aware of the impact that might have on your business moving forwards. So next, we're just going to take a little look at the barriers to growth. So, excuse me, on the screen here, you've got a number of potential barriers to growth. Now, there are, of course, many more to consider, but these are a few common issues that we see. And tying this back to the plan, the idea is to look at the factors here that could be or might be already stopping you from growing your business. Now, as I've said before, we don't have time to go through all these in loads of detail, but I'm going to take a quick look at each of these. Okay, so we're thinking about staffing. Do you have the relevant skills and expertise in the business already to enable you to go through that growth phase in the way that you want to go through it? Does your staff workforce have available time? If you're going to grow and you're going to put more pressure on people, are they going to be able to undertake those tasks? Are you going to be able to attract the right people? It's key that you've got the right people moving forward. Again, tying that back to skills and expertise. But also retaining that key talent is really important. Are you going to be able to retain your key talent? If you can't, is that going to stop you from growing a business in the way that you want to? Physical space can be a problem for businesses. Do you need more physical space? Actually, if you change your business model going forward in the plan, which means you need less physical space, is that going to be a problem to offload that? Maybe you need to change the type of space that you've got and you need to flip from industrial to more office-based space, or the other way around. Now, general economy is something that might be outside your control as a business, but it doesn't mean that you shouldn't consider it. If there's an impact in the economy, like we've seen over the last couple of years, is that going to hinder your growth? Are you actually in an industry where that doesn't matter too much? Or it might be that that's not a barrier at all, and that will actually give you an advantage. But again, we need to consider all those factors. Availability of supplies, with Brexit and COVID, again, recently, we've seen many businesses struggle to get the supplies they need to undertake business in the way that they want to. So can you get what you need to supply your customers? Is that going to be more of a problem as you grow? As you need more of those supplies, is that going to be more difficult to obtain? And can you get your supplies at the right prices to be able to compete? And then looking on at that competition, if competition in your market, in your industry, or in your area, and your local geographic is high, is that going to impede your growth? Have you got your unique selling point? Have you got your USP to make sure that you're doing a better job than your competition? But again, you've got to assess the competition to see how that might be a barrier to your own growth. Cash flow is a big factor in growth, and actually it's something that needs to be constantly reviewed. So we're going to talk a little bit more about that in a moment in a little bit more detail. Regulation, again, similar to general economy, might be completely outside of the control of the business, but again, doesn't mean that you can ignore it. Are there current regulations which are restricting your growth going forward? Or are there future changes you know about that might impact on your growth going forward? COVID, you've probably all heard enough about over the last couple of years, so I'm not going to speak about that in any detail. It's likely to have had an impact on your business, be it positive or negative up till now. But the point here is just to consider what might stick from the changes that have happened over the last couple of years, and what might the impact of that be going forward. Is that going to impede us? are there going to be some benefits there? Internal processes is an important one as well. So are your current processes and procedures robust enough to handle scaling up? It might be that they're a little bit loose and a little bit undefined. And that could cause really quite chaotic growth phase. If you're not under control internally, it might be that that's going to give you headaches as you undertake more transactions and as you deal with more people. Growing too fast here sounds like might be a strange one to think about in terms of hindering your growth. But it might be you're growing so fast right now that you're spending all of your time in the here and now and you're ignoring and losing focus on that larger, longer term growth plan. So it's really important to try and step back a little bit at the current time and just think about how you want to move going forward. So think about whether that short-term growth that you're experiencing is hindering your long-term growth. Now, doing this can sound like a bit of a negative exercise, so listing all the things that are preventing your business from growing. But actually, what you want to do is take these as opportunities and to understand the factors and think about how you might be able to overcome them. So a lot of those points could be entered into some sort of SWOT analysis, where the business maps the strengths, weaknesses, opportunities, and threats of the business. And from that, you can build a strategic plan, and it can be developed so that the business sees its way through the growth phase, and areas of weakness are strengthened, and areas of potential threat are defended against. So ultimately, looking at these potential barriers could mean you end up in a strong position. So what might have started as a challenging exercise could provide you a backbone for a strong, stable, maintainable business growth plan. So we're just going to look at a few practical considerations here. So ultimately, it boils down to a few questions. Now, what do we need to consider now? So what are the immediate factors that we need to think about? If we tie that back to the growth barriers, if we look at our staff, do we need to hire someone now? If that's an immediate thing, if we look, if our growth hangs on that, do we need to hire that person now? That's a consideration we need to make. Now, what do we need to consider later? It might be that time back to that plan again, we need to change our property. We need a property move. But actually, we don't need to worry about that for maybe 7 or 8 years because of the condition that we're in or because of the property that we're in or the lease that we've got. So we can consider that later. Doesn't mean we don't need to think about it now, though. So from those considerations, do we need to make changes to the business? The honest answer is there's bound to be some. It's very rare that you can just grow without having to make any changes whatsoever. So that then leads on to the what do we need to do now and what do we need to do later. And importantly, with all of these, do any of these changes have an adverse impact on the business? It's important not to overlook these, but it's also important not to avoid them just because they've got a short-term impact on you. So sometimes you've got to take that short-term loss for the longer-term gain. As if that's part of your growth plan, then that's not a problem. As long as we understand why it's happening, why we're doing it, and what that longer-term benefit is, that's just part of the journey and just part of putting the plan together and seeing it through. There are 2 areas that's run through almost all stages of growth. And I mentioned those at the start, and this is risk management and cash flow. So we're just going to dive into a little bit more detail on some of these. So the first one is risk management. So if we've got increased trading risk, there's a pretty good chance we've got increased risk. As we undertake more transactions, as we get larger transactions, there's a good chance that our risk profile increases. So this could be at varying levels, and it can come from a variety of sources. So we're just going to touch on a few of these. IP protection is the first one we're going to look at. So if you're generating IP as a business, if you've got something niche about yourselves that you want to protect, you've got to make sure that is protected. Now, if I tie this back to the growth phase again, to the plan and the staffing considerations, it could have an impact on whether you use external contractors or use your own staff. So IP developed by external contractors might default to become their ownership, whereas with staff, it always attaches to the employer. So that could change actually how you look at that and how you employ that person or how you instruct people to work for you. What's key is that you don't lose that IP because others might take advantage of that and you might lose your competitive advantage. The way to protect this one is just looking at good legal agreements, making sure that if you do have contractors, you've got that agreement in place to say who the IP attaches to, and have a little bit of clarity as to what the IP is in the first place. Terms and conditions is our next one here. So again, high volume of transactions could lead to a high risk of maybe customer defaults, customer disputes. It could be some supplier disputes that could be covered by T's and C's. There's potential for litigation here for non-performance of your duties as a business under your contracts. Depending on what you do, that could be a greater risk than other businesses. So what you need to have here is strong enforceable T's and C's. If you simply adopt a boilerplate example, it might not be relevant to the business. That might increase the risk that you're going to suffer from these issues. And actually, then they're literally not worth the paper that they're written on. They won't be very useful for the business. Another area of risk is HR. So as you grow, as you get more staff, you're likely to end up with a more complex workforce. And this could result in a higher number of issues to deal with within the workforce. At the very least, it's more admin. There can be a lot of points to consider here in terms of managing the risk. And at the basic level, you want to make sure that you're abreast of things like your general employment rights, your maternity pay, paternity pay, statutory sick pay, holiday allowances, and all the sort of general day-to-day things. It might be slightly more complex than that, and making sure that you have a robust complaints procedure that's fair for all to use. It might be that you need to ensure that your HR process has a proper appraisal process in place, so that any strong performance is rewarded and any underperformance is targeted. But actually, it might be a little bit more than that. So it might be that you have a mechanism for rewarding and retaining your staff. You've got to make sure that that's fair and not discriminatory in any way. So those, if you get them wrong, can cause an increased risk and therefore could cause harm to the business moving forward. Key persons is another area just going to cover here. So the likelihood is in your business, there is a key person or maybe multiple key people. What happens if that person is incapacitated? What happens if one of them leaves? What happens if there's a major disagreement? If you're managing a growing business, that can be a really stressful situation to be in, and tensions can run high. The larger the business might mean that you've got more key people involved. What you want to do there is just understand what that risk is. And then general risk. But this could be anything else. Now, the point about this is assessing the risk profile is really important to the business. Ultimately, the value of the business will be dictated by the risk profile. If you've got higher risk, it's inherently worth less. And if you've got higher risk, lower risk, is inherently worth more. So how do we manage those? How do we target those? How do we deal with those? Well, there's a couple of ways really. One is having good legals in place. So if we're looking at IP protection or terms and conditions, having a good, strong legal contract that sits behind those is going to reduce your risk in those areas. It could be that actually you're looking at good insurance. So your general business risk, you're likely to have a general risk policy, but make sure that's a good policy and not just a sort of, you're not accepting one because it's cheap. Key people also is an important one that you can insure against. So particularly for things like incapacitation of directors or key management staff, you can actually undertake policies there where they pay out should something happen to the people. So what's key here is just to understand all of those risks and how you might be able to reduce them and how you might be able to manage them. Because ultimately, if something goes wrong in one of these areas, it could have a real impact on the business moving forward. At the very least, you lose your focus for a little while on those growth plans. So going back to the start of the presentation here, in that planning step, is about having good advisors. Make sure that you can speak to someone about these elements. Now, it might be that you speak to your solicitor, it might be that you speak to your accountant advisor, it might be that you speak to an insurance broker. Whoever you speak to, just make sure that you listen to them, explain the situation clearly, and listen to what they've got to say. They'll be able to help you through that process. So the next bit we're going to look at here is cash flow. Cash flow management can be challenging at any time, but particularly challenging when you're going through a period of growth. Why is that? Well, that's mainly because growth tends to cost money. Everything I've spoken about so far is likely to cost money at some point. So staffing, if we're taking on new members of staff, we need to outlay the wages for that. If we're needing to change premises, then there's going to be a cost implication there. It might be the moving costs, the rental costs might go up. If you're purchasing a property, that's obviously going to cost a lot more. Supplies and materials, needless to say, you're going to have to pay for those. Insurance, lawyers and your advisors. They all cost money at some point. So the more you grow, the more you're likely to need, and therefore the more it's likely to cost. It's rare that you see a business that can simply flip a switch and scale up without any additional cost incurred. And the reality is that most of these costs will be incurred before you receive any revenue. It might be before you've even earned it. So taking it back to that staffing example, if your growth hangs on having an additional member of your sales team, or an engineer, a skilled member of staff, there's a good chance you need to employ them before you see the full benefit of the growth that they can provide. So how can we manage cash flow then? How can we look at this? It sort of boils down to a few steps here, really. So plan. Initially, I'd say do that outside of the numbers. So look at that plan. All right, it might be based on a number. So it might be that your growth plan is to target a certain turnover level. It might be to target a certain profit level. It might be to target some other sort of financial metric. But what you want to do when you've built that plan in terms of how many staff you might need, where you need to be, the sort of back office elements that you might need to introduce, just look at those aside from the numbers to start with and think about what that actually means in terms of the layout of it. And then look at your forecast. So then once you know what you need to do, put some numbers to those. So again, using the staffing experience, the staffing example, what are those staff going to cost us? Using that premises, how much is that going to cost us? If we need to do legal contracts, let's factor all those things in. What's our gross profit margin? Let's look at all those bits. So start to put numbers to the plan. And what you want to generate from this is a fully integrated three-way forecast. So you've got your profit and loss account, your balance sheet, and your cash flow forecast that all hang together. So when you change one, they all change. Now, I've said again, it's important for the numbers to come second on this bit because you don't want to make the plan fit the numbers. So some people might target a particular turnover point, or they might target a particular profit point, and they'll build everything else around that. That might not be the reality of the situation, because it might be that actually you need to consider your staffing first, or you need to consider your environment first. So make sure that you look at it the right way around. If the forecast doesn't look right, then think about why that might be. Once you're happy with that, then you're looking at scenarios. So create a set of alternative scenarios. Well, do the sort of what if scenarios. Well, what if my growth is 20% higher than I expect it to be? What if it's 20% less than I expect it to be? What does this do to the forecast, particularly the profit and cash flow? Does the business look like it's going to be stable enough through this growth? Is there something else we need to factor in should those instances occur? So if we're growing really fast and faster than we're expecting to grow, do we then need to get something else in place? Does that change anything else in the model? Review step is next. So at the planning stage, this is really important, just to sit back and think about what's included. Is this forecast in line with the plan? Can we achieve that plan? Are we being a little bit too ambitious? Maybe we're not being ambitious enough. Maybe we can push it a little bit further. Is there anything else that we need to amend in this? We need to review that in detail just to make sure that it does fit in with what we're expecting. And also to make sure that we've not forgotten anything, making sure that the numbers link together properly and that they make sense alongside each other. And this review section carries on through the growth phase. So actually, while you're growing, track your actual results against your forecasts and against the plan. Is it in line with your expectations? Are you where you thought you would be? Now, this is where the scenarios come in handy, because if you're above, you've already got a plan set that maybe covers that. If you're behind, maybe you've got an alternative scenario that covers that. So it means you can compare, and then you can look at how you're going to move forward from that point with that plan already being in place from beforehand. The last point on here is revise. So forecasting is just a forecast. There's a pretty good chance that you're not going to end up where you were hoping you were going to be or where you thought you might be. So go back to that forecast, go back to that plan, amend it for any changes, any deviations from the actuals, or any new developments since it was created. As your business has moved forward, it might be that you've not quite gone in the way that you thought you would. So it needs to change some relationship between the numbers. The whole process should be regularly reviewed and ensure that it stacks up, ensure that it remains up to date and relevant. Now, from this cash flow, there's a strong possibility, particularly if you're going through the growth phase, that there's going to be some pinch points in the cash flow. So you might need to look at ways to plug those gaps and gain some additional finance if needed. So we're just going to look at those really briefly here. So there are a few ways in which funding can be obtained if you've got those areas of sort of low cash. Some are going to be more easy than others, some are going to be more expensive than others. All of them will have their pros and cons. I'd recommend that you explore them all in all situations and just understand which source fits best with the need of the business and the longer term strategic plan. So just very briefly on each of these, I'll just give you a couple of comments that I think might be useful. So if you're looking at bank borrowings, now if you've got a good trading history, you've got good financials with your bank and you've got a good relationship, this could be a good option. It might be relatively straightforward to obtain. It might not be that expensive if you've got good financials behind you. The overdraft. Now, although we see a number of businesses use this for day-to-day trading, actually it's really good for just short-term use because the interest rate can tend to be higher on overdraft. But what it does brilliantly is just provide you with that flexibility so that if you need it, it's there. If it's not, you don't use it. That means overall it might be more cost effective, although the interest rate at the point you're using it may be higher. Because although maybe you have to pay an arrangement fee, if you're not dipping into the overdraft, you don't need to pay the interest on it. External investors are more of a longer term strategic alliance, I would say. So they're much, they're excellent where you need to build strong strategic connections, because those investors might be investors in other businesses. They might be able to put you in touch with those businesses that might give you opportunities to grow. Things to be aware of here is just make sure that you're aware that you're giving up a proportion of the business. And actually that investor is probably going to want a return, depending on the investor, depends on when they might want that and how much they want. But that's a key factor in their investment. They want to get something back for it. Asset finance can be a really good way to obtain some funding. Typically, depending on the type of asset you've got, that's likely to be a short-term finance situation as well. So it could be just 3 to 5 years. And if you've got a strong asset base to borrow against, then it might not be all that expensive. Crowdfunding we've seen used to varying degrees of success. Some people obtain funding through it, some people don't. The amounts through this aren't always massive, but what you've got is, with the platform design, typically the investor spreads their risk profile, so that might actually not be too difficult to obtain that funding. Working capital cycle doesn't necessarily seem like an obvious one in terms of obtaining your cash flow, but it's actually a really good source. So if you can stretch out your payment terms to your suppliers and you can reel in the payment recovery days from your customers, it can make a huge difference to the cash in the bank. Now, it's not likely to happen overnight, which is maybe the downside of it. But the overall cash the overall cash injection isn't a big lump necessarily in one go, but actually it can make running the day-to-day business a lot more maintainable. So family loans are popped on the bottom here as well, and this could be friends or family, more likely to be for smaller amounts. The benefit with these is they might be a little bit more friendly to agree terms with. The downside is, they might come with a little bit more pressure. You might have a personal tie to that person. So you might feel that you need to satisfy that loan before anything else. The thing I'd say with these is, if you're looking at any source of finance, just again, speak to your advisor. Get to fully understand what the business needs in terms of their cash flow injection. And understand the implications of each of these, what the good bits for the business could be, what the bad bits for the business could be, and make sure that it ties in with that longer term strategic growth plan. So just to cover off what we've spoken about so far, what we've spoken about today. So we've looked at planning, we've looked at the barriers, practical considerations, risk management, cash flow. So just to reiterate, if there's anything on here that you'd like to speak to anyone about, feel free to contact myself. My details at the start there. Or if you've got contact at Menzies already, feel free to contact them. We're more than happy to speak to you. Finally, I'll just leave you on this slide here. So this is the next webinar in the series, focusing on how to plan and prioritise for the medium and longer term. And this is for those businesses in the mature stage. So there's a QR code here again, so that you can just click on that one. Sorry, not click on that one. You can use your phone to take you directly to the booking for that one. And we'll leave that just for a few seconds. But thank you all very much for listening.